Hello, and welcome to our quarterly podcast on financial transactions and transfer pricing. During these podcasts, we have discussions with our specialists of the PwC network on relevant topics in our area. And today, my guests are Martin Cazaux of PwC US and Tony Koivula of PwC Finland. And I myself am David Ledure of PwC Belgium. Today's topic is debt capacity and transfer pricing. Because as you likely know, when you talk about intercompany financing, it's not only a matter of arm's length interest rates, but also the amount of debt should be arm's length. And this can be linked to what the OECD is calling the accurate delineation of the actual transaction. And just for the sake of completeness, we know that quite some countries have also specific interest limitation rules, typically based on EBITDA. But very often, these specific interest limitation rules do not preclude tax authorities for also testing the debt capacity from an arm's length perspective. A question to you, Martin. The US have a long history of looking at debt capacity. Is there a specific legal basis to do this, or is it more based on case law and practices?
Yeah, thanks, David. And indeed, long history, different set of regulations around financing in general, and various court cases around the debt capacity or the debt equity issue. Interestingly, this issue is not addressed in Section 482 and the Treasury transfer pricing regulations. But in the US, the ability of a taxpayer to deduct interest on debt from a related party is contingent on whether the debt is considered bona fide. Or in other words, right, is it true commercial debt that a third party would have entered into, or is it some other form of capital like equity, right? The issue is described in Section 385 of the Internal Revenue Code, but the resolution of whether an intercompany debt obligation is bona fide has generally been considered in the context of principles established in US tax court decisions, right? US case law. And the approaches taken by the courts have varied and are different, but it can be best described as fact and circumstances driven. So an evaluation of quantitative and qualitative elements has generally been considered in different court cases, which the analysis, one could say, that are consistent or even based upon insights from rating agencies, commercial lenders, and overall their analytical approaches that are based on a review of the markets and financial metrics that are relevant to the markets. For example, in various cases, at least, one financial ratio was considered. And by ratios, I mean, think about debt to equity, debt to capital, interest coverage type ratios, or financial covenant ratios you will find in arm's length debt facilities. But also, on the qualitative side, right, like the existence of an intercompany agreement, the terms and conditions within that agreement, or the relevant terms of the debt instrument, the ability of the borrower to repay, and other factors have been relevant that have been considered in case law. But again, primarily driven by principles established by the courts and based on evaluation of different quantitative and qualitative factors is what drives the issue around the capacity.
Okay, so in US, three important numbers, 385, 163J, and 482, but also a lot of case law. In Europe, Tony, if you look to the various European countries, are there also specific laws on this, or is it more practice based on general principles?
Thanks, David. Usually, the debt capacity is included in the local general transfer pricing provision, but in some countries, we have seen that more detailed guidance issued by the tax authorities is also coming. But let's say that specific rules or guidance is still relatively rare in Europe. However, we are seeing more attention to be paid by the European tax authorities on debt quantum questions, especially in connection to financial transactions tax audits. Recent attention in Europe is at least partially caused by the new Chapter 10 on financial transactions in the OECD guidelines, but potentially other reasons and developments in the local tax codes as well. Therefore, it's more practice driven than by the legislation that compared to the United States or other countries, but we are seeing more and more guidance issued by the tax authorities also in certain European jurisdictions.
Okay, thanks. Yeah, and you referred to the OECD guidelines in Chapter 10. What's a bit surprising to me is that even in the very old versions of these OECD guidelines, there was already some reference to equity and whether debt should be considered a debt or more like an equity-ish type of financing for transfer pricing purposes. But in the past, I don't think it was used a lot in Europe. So this is a bit the theory. Now, Martin, if we have to do this in practice, what to look at, how to analyze things, what are the items you typically cover in such an analysis?
Yeah, thanks, David. This is a great question. And let me say that this is the area where you will see that the approach may vary by country, right? Or maybe better, the predominance of certain analysis, right, or principles may vary by country. But in the US, we generally look at various factors or variables, right, consistent with the principles established in case law, but also how markets typically look at this issue, right? Keeping in mind, and I think the framework is important here, that the objective here is that from a transfer pricing economics perspective, right, the objective here is to assist in demonstrating that a borrowing is commercial, right? It's bona fide from a US perspective, and that the expected financial performance of that borrower, right, is consistent with independent borrowers borrowing at arm's length. Like I said, various factors to consider, but I think generally the quantitative analysis, can be grouped or summarized under three main questions, if you will. And I'll cover this not in a particular order. I think the relevance may vary by country, like I said, but you will look at, question one, I'd say, is would the borrower want to capitalize itself with the stated level of debt, right? Especially consider its financial performance against peers. So this involves an evaluation of the borrower against comparable peers. And by that we mean, peers in the industry, in the broader sector, financial peers, but not necessarily in the same industry. And looking at financial performance ratios. And these ratios are going to sound common to everybody, like interest coverage, leverage, cash flows, profitability type ratios. The second question is around analyzing whether the borrower could obtain this level of financing given current market conditions, right? So this is a little bit of a lender's perspective, if you will, right? So it's analyzing current debt market conditions and lending multiples based on recent transactions. Are companies obtaining debt at this level in the marketplace today or at the time of issuance? The third question is around cash flow serviceability and whether the borrower would have the capacity to service its debt obligations, right, including repayment of interest and principal over the lending horizon. And this is a fundamental test. I mentioned it briefly before, but it's a test around the ability to repay, right, based on projected free cash flows. And I think when the preference, predominance, or reliance on a particular test may differ, I think generally we see this issue analyzed quantitatively under these three broad kind of variables. And with the logic, I think the logic is important, right? But the logic behind this is that if the borrower financial performance is comparable to peers, test one that I covered, and is the borrower performance or ratios, comparable to those observed in the marketplace, test two. And we can also show that via cash flow analysis that the borrower can service its debt obligations, test three, then the results would suggest that, based on this quantitative measures, if third parties can obtain financing, the borrower should be able to obtain financing under similar circumstances. And therefore, we have established a quantitative analysis, a quantitative framework supporting, the commercial bona fide nature of the debt issuance.
Okay, thanks. Tony, I know you have done an informal sounding within the PwC network in Europe to have kind of a feeling of how the various tax authorities approach this. So what are the key takeaways if I ask you the similar question as I did to Martin?
Yeah, thanks, David. Basically, in Europe, there isn't as established practice on how to demonstrate that the debt level is at arm's length. But we see a trend that there is certain ratios such as debt to EBITDA, loan to value, loan to cost, debt to equity, interest coverage, as Martin mentioned, that are quite commonly mentioned in the network and used in the analysis. But ultimately, obviously, it depends on the sector where the taxpayer is operating. And for example, in the UK, they have the could and would test. So could the taxpayer pay the debt, and would is whether it makes sense for the taxpayer to have that amount of debt in its balance sheets. So it depends a lot on how established practice is in the said jurisdiction and how sophisticated the tax authorities are. But in practice, this is something that is not as established as in the States, but certainly certain ratios, for example, are visible throughout the European countries.
Yeah, and I hear, although it's less developed, it's not as long as in the US, I hear a bit the same type of test coming back. So the coulds and the woulds. So could it comes back a bit to debt serviceability, and the woulds, it's how you compare to the industry. Yeah, and as you also rightfully say, some ratios are more generic, and debt EBITDA is a generally used ratio, while loan to value, it's typically for real estate transactions. Loan to cost, it's more for real estate development and the like. So it's also industry specific. Also want to chip in on an Australian proposal I've read recently. So we don't have anyone from Asia Pac on the podcast, but it's as relevant, I think, in that region. And what I've read is about draft legislation issued by the Australian authorities. So it's out in the open. It's they request some public comment. So everything I say here, it's public information. And I think it's relevant for two things for the broader world. It's first of all, Australian tax authorities typically tend to be a forerunner in all these things. So whenever something happens in Australia, quite some other countries follow afterwards. And secondly, this draft legislation would already be applicable as from the 1st of July this year. So it's really imminent. Content-wise, I've noted some changes or replacements of the current rules. In the past, there was a safe harbor rule where you could justify a debt quantum up to 60% of the assets. That would be replaced by 30% EBITDA rule. So in line with OECD Action 4. There would also be a kind of group carve-out based on the group's interest EBITDA ratio. Thirdly, you would also be able to justify a certain level of debt if you could make a direct link with third-party debt. So even if it's not direct third-party debt, but indirectly, and you can justify it's fully used for the Australian operations, then you could also use that. Although it's less clear for me at this stage, my understanding is that these specific rules do not preclude a more generic transfer pricing analysis of that capacity. Now, as you hear, my accent, I'm not Australian at all. So if you want to have confirmation on more details, I would highly recommend to reach out to our Australian colleagues. Maybe back to you, Martin. You mentioned debt serviceability or cash serviceability. It's typically based on forecasting of the borrower, so this provides quite some interesting information. Now, debt capacity is one of the terms conditions that you should be able to justify whether it's reasonable. But there's some other terms and conditions that could also be looked at by tax authorities, like the maturity, whether it's a bullet or an amortizing loan, some tranching, and so forth. Can this debt serviceability testing also be used for these other terms and conditions?
Yeah, thanks. It was a good question. I think there are, when I think about cash flow serviceability and this test, there are two main points I think to think about or to factor in when it comes to this type of analysis. I think the first one is that, it's indeed an important factor considered by U.S. courts, right? In particular, the ability or the failure of the debtor to repay, right? There's reference to that effect in court cases. And I think similarly, Chapter 10 of the OECD guidelines, I think that addresses or mentions the importance of establishing the ability of the debtor to repay on the due date, right? Or to seek, I think the OECD mentions a postponement, so like a refinancing alternative. So hence, it's an important variable to evaluate and consider, right? Whether it's the primary or the secondary approach, I think that's up for debate, but I think we would all agree it's an important test to consider. The other point here to keep present is, and I think to your point, the cash flow analysis, it could be very helpful to support the overall structuring of the financing, right? For example, when you're evaluating the appropriate duration, right? Sometimes you can refer to the cash flow in order to determine, what's the appropriate duration of this instrument. Or also when it comes to tranching considerations, right? When the company wants to, break out the debt in different tranches, well, the cash flow analysis will help inform, how to structure the tranches, when it would be a good time for each of the tranches to come due. And I think other considerations, right, come to mind, like prepayment options or other options within company arrangements, right? And how could that be modeled via the cash flow analysis?
Okay. Yeah, and you mentioned should be able to demonstrate you can pay the interest, but also to repay the principal amount. And this often gives rise to some discussions. And I know some tax authorities, they look at it very narrow. So they basically expect you that you generate the cash to simply repay the loan, while you can also repay a loan by obtaining a new loan at maturity of the initial loan. So basically refinancing. And what you see in the open market, it's seldom that groups fully repay their debt. Typically, they're kind of a continuous refinancing, trying to achieve a certain debt leverage that they consider optimal.
Yeah, I think it goes back to the commercial nature, right, and how the markets look at this. And certainly refinancing options and considerations are relevant in this case.
Mm-hmm. Absolutely. Yeah, some loans have a fixed rate, others have a floating rate. Since a couple of months, we are living in an environment where interest rates have increased very strongly for the first time in more than a decade, almost a decade and a half. I think in this type of analysis, if you use a floating rate, some type of stress testing could also be useful to demonstrate that even if interest rate would go up a bit, based on how markets see the market further evolve, that your debt serviceability is not endangered, so you can still confirm this. Assume that your debt capacity is reassessed by tax authorities on a tax audit. Is it just a fact of life, or is there something you can do around this, Martin, like maps, APAs, and so forth?
Yeah, thanks, David. Yeah, I'll come back to like what can be done in a sec, but I think this putting in a little bit in context is helpful too. But like what I think it's interesting in the controversy space and how the audits and questioning is evolving around this issue. And in my experience, right, and I'm a TP practitioner, right? So generally, the arm's length nature of the interest rate is still what's primarily challenged, right? But at least in my experience, the interesting development is that the discussions are not stopping there. And we're seeing, the discussions evolving into the debt capacity area, right? And while you've been answering questions around interest rate, questions are raised on the quantum, right? On the amount of debt and whether the borrower can support that amount. And we see this in US audits, but more interestingly, we're seeing it in kind of more cross-border type controversy, like map cases, for example. In terms of your question on, what can be done, I think the best approach or the best practice I generally suggest is, prepare robust documentation at the time of issuance, right? At the time or as close as possible to the time the transaction is entered into, and not after the fact once the debt has been issued, right? And there's not a lot you can do other than supporting what has already been established. And by that documentation, I mean, supporting the arm's length nature of the interest rate, but also the debt capacity of the borrower, right, to support the contemplated level of debt in the intercompany arrangement.
Okay. And with this, we're almost at the end of the podcast. What I've learned from the discussion is that Debt capacity is something that should be looked at, even if countries have specific interest limitation rules, which are more mechanical. On how to do it, a lot of different approaches in various countries, but I kind of see two categories of tests. The first is linked to the serviceability of the debt, so doing some forecasting and based on some financial ratios to see whether you can actually service the debt. And then the second category is what you refer to as the wood test. Look at peers, look at comparables to see that you can see similar leverage ratios in the market. And to end on a more positive note, when tax authorities apply interest limitation rules, these are non-deductible, it's full stop, maybe with some carry forwards, but it's final. If tax authorities, however, reassess your arm's length debt capacity, you can still avoid double taxation. So typically you can put this into MAP, but why not also consider APAs, especially if you're talking about very, very sizable transactions. And with this, I want to thank our listeners for tuning in and Tony, Martin, our speakers, for sharing their insights. And I'm looking forward to our next podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.